People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the Black Swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees. They don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Hello again and welcome to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Online, zinniawealth.com. As always, my name is Randy Cook, and each week, Charisse and I sit down here and talk through some of the issues of retirement, some of the stuff that you might heard about, you might be experiencing, you might be wondering about, and we're going to kind of go through a lot of that stuff about income in retirement, the stock market, all sorts of different things that might be kind of on your mind as you get toward retirement. Charisse, how are you doing today?
Doing great. We're still living off our Easter egg hunt at Team Zinnia. we gave a day away, paid a day, lots of fun gifts. So one of the ladies came to me and said, "Thank you for just always setting that up for us." They just had a good time. Feel like kids at Team Zinnia sometimes. Got to bring back that childhood memory.
Yep, Cherie showed up with bunny ears on today as we were recording the show. So, yeah, she's in the spirit, so to speak. All right. Now, let me ask you this. Do you go every year and buy the little plastic eggs and then open them up and then put the M&Ms in there and then close them up? Or do you keep your eggs from year to year to year like what my daughter does?
So I keep my eggs from year to year and I fill them with different things. Like for the kids, I put like quarters and dollars and $5. And there's always one big grand poopah egg. But I keep them. But this year I was like, I don't know where they're at this year. And I'm like, I just started buying and I'm like, you know what? I don't have time to look. I'm a little behind. So I just bought new eggs. So now I got more eggs going on top of the eggs. So the whole point of it, if we can have a massive Easter egg hunt one year, like there'll be hundreds of eggs.
I love it. All right.
It's fun though.
Well, we talk about your nest egg in retirement, and that's kind of what we're going to talk about here. Let's talk a little bit about our nest eggs that are in the stock market. I mean, Charisse, we have seen a lot of volatility. We got to that 50,000 mark and everybody was celebrating and the confetti fell from the sky. And then, well, that didn't last long. And down she went again, 8, 9, 10%. Yeah, about a 10% pullback. And so as people are looking at this, how should their perspective be? I mean, if you go back 10 years ago, the Dow was at 17,600. Okay, that's 10 years ago. Today, we're up in the mid 45,000, 46,000, right in that vicinity. So we've done really, really well over 10 years. And then if you see a 3% or a 5% pullback, you go, oh my gosh. What do we say about that?
I know. Greed and fear.
Perspective, people.
Perspective. Listen, over the last few years, people have gained nearly over 50% in gains. And then everybody has a heart attack because they lose 5 or 3 or 10%, which we do know could keep going down. It's the unknown. And so I just tell people, like, if you really did worry about a 5% or 10% decline, that just tells me you don't know what's going on inside your portfolio, or you don't know how far it could draw down, or you don't have enough safe money built in, making money more conservatively to not fear and make these emotional decisions to sell when the market goes down. I mean, because in retirement, you walk out the double doors to your employer, you collect your last paycheck, and you're leaving all the stress of life, and now you're going to go enjoy your retirement years. So I tell people, don't trade the stress of work for the stress in retirement because you don't have a written plan nor understand it. And so I just feel so bad for people who don't come in and see us and get this type of energy and this type of comprehensive plan, because they're never going to know what it's like. And they're going to keep doing what they're used to doing. They're going to chase the tail of this rocket ship, and eventually they're going to get burned, right? But it's okay to get burned. That means the market went down some. It always comes up, but how long does it go down, and how long does it take it to go back up? That's the key. And if it takes 2 years to go down, and then it takes 4 to 5 years to recover, well, you might be in big trouble if that's where you derive your income from. So we want to talk about buckets and how to pull income. And when times like this happen, where not to pull the income, because it's a withdrawal strategy. And a lot of people stress out about withdrawal strategy, when and how and who. And that's what we're coaching up here.
Well, one of the things that you've said over the years, probably in most every show, is you're not supposed to be taking money out of a falling bucket. Right. So if the stock market is falling, that might not be the place where you're going to pull your income from. Don't pull it from a falling bucket. And Sharice, that means probably they don't have the other bucket.
Right.
And that is what it is to have an income plan and have a retirement plan in retirement. And if you have all of that stuff lined up, you've got to feel just a little bit better during these times that we're going through right now.
Yeah. I mean, the biggest fear is running out of money in retirement. Everybody said, that's my biggest fear. It doesn't matter how much money you save. I hear it day over day over day. And the only reason why people fear it is because of this thing called sequence of return. It just means, what are the returns that you're getting when you start pulling money out of your retirement accounts? And if you have a negative 2 to 3 years in your first 5 years, it's very problematic, number one. But if you have positive years as you're taking money out your first so many years, it's less problematic. And we show people the math. Like, what if the market did go down right now and you're pulling this much money out? What does it look like really in 20 years based on the last 20 years? And it's a feel-good illustration that we show because most people haven't seen that before, and it's very valuable. And they sometimes they just don't even know how risky they are, Randy. They're sitting there and they think they're conservative, like new people who come in and we do the stress test. We're like, yeah, you can lose 40 or 45%. Are you okay with that on all your money? They're like, no, actually, I actually didn't know that. I thought my advisor was taking care of me. And they're very, very well are taking care of you. But you're in a decumulation phase of life. You're living on your money, not an accumulation phase of life where you're just building it and letting it grow and contributing to it. So the game changes. And that's why Zinnia Wealth and our team is so valuable more now than ever, because we haven't seen a crash since 2007, 8, and 9, right? A lot of you who are retired has not lived on your money during a crash yet, which is scary. You worked through it, but you didn't live on income through it. And so we're putting our heads in the sand and we're ignoring it. It's so because we just don't know what we don't know, unless you're listening to our radio show and you start to hear this noise. And, it's incredibly important. There's no better time than the present because there's global uncertainty. I feel like markets could continue to go up and do well, but I'm not going to pretend I know. I don't have a crystal ball. We just want to make sure we have enough in the market to capitalize when the market goes up and enough in safe money and different strategies. So if it does, we got a plan.
I was reading an interesting article, and it was about a financial advisor who took a new client out to dinner. And they're sitting there, and the client had quite a bit of money, and it was feeling pretty good about everything and saying, the market's kind of getting wonky right now, but I should be okay, right? And the financial advisor says, yeah, as long as the market doesn't continue to go down. And the client said, well, I feel pretty good anyway. And he looked at the table and there were 3 breadsticks in the basket right there, right? So he said, okay, let me show you an example here. So he took one of the breadsticks and he took a couple of crumbs off it. And he goes, this is you taking money out of your nest egg, little crumbs at a time, okay? And he said, yeah, I get it. And he says, this will last a long time as long as you're taking little crumbs. He said, now this is what's going to happen with the market. And he took one of the breadsticks and cut it in half and then threw it and said, okay, now you've got this much to work with. And he goes, okay, I get it. Because, you're taking your little breadcrumbs off of less bread is basically what it is. And that's what sequence of return is. So during these times like this, if this has you shook, whether you are in retirement or getting ready for retirement, this is a message to you. There's a little test going on right now of how you feel about risk. And if you're kind of got a knot in your stomach and you're walking the halls at night and you're not sleeping well over it, well, that is a sign. Come in and see Sharice. Let's put this down on paper and get a strategy for you. 833-368-3680. 833-368-3680. Let's get a date on a calendar, or just use the website. You can do the same thing. Complimentary retirement consultation. You'll see a gold box there. You click on that and you'll be ready to go. Well, speaking of buckets of money, an interesting study. Now, these are two guys that we've talked about before. They're researchers. They're financial writers. The names mean nothing to you. It's Michael Finca and David Blanchett. And they did a study to find out how people spend in retirement. And the people who are happy and doing it right and enjoying their retirement, what are they doing? So here's what they found. If you have a bucket, which they refer to as guaranteed income, it could be Social Security, it could be a pension, it could be an annuity, something that kicks off money, a guaranteed bucket of money. People will dive into that bucket at about 80% per month. If you have your 401k, your investments and things like that, people will go in there and take maybe 50% of what they need per month. The people who have the bucket that they know is going to get filled up every month enjoy their retirement more. They spend more freely. That's got to be a big topic of conversation when you build a retirement plan, Charisse.
You know, I've been following David Blanchett for a long time, and we haven't talked about him in a couple of years, actually, but he's a retirement, academic professional, and he does the math and he tests all these strategies. And I'm glad to hear him say that. I didn't hear that prior to this because it's so true. My clients that have Social Security and pension coming in, they will spend all of that money on their bills and travel and having fun. If those same clients, I've asked them before, if those same clients came in and didn't have the pension, but they had Social Security, and then they had to pull off this pile of money, I ask them, would you spend as much money? And they're like, no, because we got to pull it off. It's a psychological thing. And so what we teach here at Zinnia is that it's okay to pull money from your portfolio if you don't have a pension and you're collecting Social Security. There's just a strategy of how, and you split up these different buckets, and then you turn on these light switches when it's time to keep up with inflation. When it's time to maybe shift gears because we don't want to pull money out of the market. When it's time to raise our income. And then also when it's time to say, okay, we went through our go-go years. We spent more than we ever imagined because of your plan, Charisse. And now we're going to pull back the reins because we're not going on our cruises to Alaska. We're not driving our RVs around. We're just like, we're going to lay low. And then we get into the second phase of retirement and you actually spend less. Every single person I've ever met in this industry that I have sat and got eyeballs on, clients have done this. And actually they do it sooner than I expect a lot of times. So we want to make sure we're front loading retirement, those go-go years, so you can go spend it while you have your health, because you're going to be the healthiest you're ever going to be the next 10 years. And if you have a pension, I know you're probably already spending it. But if you don't, we can create a little private pension and then have some other growth and safety strategies built in so that you feel better about pulling money out of these buckets. And you know when you're going to pull money out of those buckets, AKA the withdrawal strategy, and on what accounts.
So, Charisse, one of the things that also occurs to me with this is that bucket of money kind of represents that paycheck that you got every 2 weeks or every month. And I think that as you go into retirement, there's so much that's different. If you can build that, it's kind of like my working years. The change is a little bit less. Do you agree with that?
Yes. So when we're working and we get a paycheck, you're spending every dollar. You're putting money into your 401ks, your IRAs, maybe a Roth 401k, and you know exactly what you get to keep to either put a new roof on your house this year or go get a new water heater or take that one trip that you want to take every year with a family or whoever. And then there's nothing left usually until the kids are out. Then we start to see people save a little bit more from their paychecks. So something about that paycheck and income makes the world go round, right? And having those paychecks coming in every month, every 2 weeks if you're working, is absolute certainty, absolute peace, as long as you still have that job, right? It's like if they know that it comes in, they know what they can allot and what they can spend. And it's the same thing in retirement. If you have paychecks coming in and we force these paychecks on you, you are going to spend the money. Now, if I don't give you those paychecks, and we do it in all different forms, whether it's from your Fidelity accounts, your notes, or whatnot, or maybe if you have an annuity, like maybe we'll take it out of all the accounts. It will totally depend on goals, wishes, dreams, how much we need, but we want to be diversified in there. But you will spend money. I know this for a fact because when I don't have checks coming out to you, you're not asking me for money, right? And you're not spending as much money. So I just had somebody come in and we did that. I'm like, hey, we're going to start our paychecks. It's been 6 months. You're retired. And they're just like, okay, what are we going to spend it on, Charisse? And I said, well, what are we doing? Let me look at the notes. You said you wanted to go on an Alaskan cruise. I'm like, do you want the lump sum or do you just want paychecks every month for this? And they're like, yeah. He's like, okay, yeah, we're spending our Social Security check. We're ready to start spending money. So we have to have these ongoing conversations. It's hilarious to me because you don't have to ask me for money, but I'm like forcing people to live on their income because I just have seen so much happen, Randy. I've seen people die early. I've seen illness early. I've seen so many things and so many people over the last 20 years that did not spend their money accordingly. Right. And accordingly means the first 10 years of retirement, because so much can happen. You can lose your eyesight. Now we can't do squat ski. You can have dementia. I have these doctors, and one of the doctors, they retired just a couple of years ago, and now we have this set of dementia. And then they just came in, and that person cannot see very well now. And gosh, I'm so upset about it because it's like, gosh, we just retired and they're young and you just don't know. They're early 60s and
wow,
it's you just don't know. And so here are my stories, fill my stories, because it could happen to any of us, the healthiest people out there. So it's hard for me to watch, but this is why I share these stories.
Build those paychecks, enjoy your retirement. As Charisse said, the future is not guaranteed, but at the same time, we may have a 25, 30-year retirement. So having money management in our retirement is very, very important. And to sit down to talk to Charisse about how it works for you, give her a call. There's a no cost, no obligation look at your retirement. Sitting down and saying, here's what you've done for retirement. You've saved all these years. This is what you want to do. These are your monthly bills. Boy, there's a lot of math that goes along with it. So we say it every week on this show. Let's do the math on your retirement. 833-368-3680. 833-368-3680. Or ZinniaWealth.com, ZINNIA Wealth.com. Click on that gold box. You'll be on your way. All right. So Fidelity did an interesting study about retirement timing. They asked people who were getting ready for retirement, and they said, hey, do you think that you're going to be able to do this on your own time? And 72% of people said, I've got enough money. I think my job is solid, and I'm going to be able to retire on my terms. 72%. Then they talked to people in retirement, said, how'd that go? 56% of them, over half, said, I had to retire not on my time, but on somebody else's time. I lost my job, whatever like that. So this is something that we hear regularly. You may think you're going to retire at 65 or 66 or 67, but get ready for something that might get in the way. Charisse, what do you see that gets in the way? What are the most common things that you see?
Yeah. So, a lot of people say, hey, I'm going to retire on my timeline. Sometimes they retire too late because they didn't work out a plan. But the people who retire early because they're forced, I see that more often than not. So I'll see layoffs, right? We've talked about those stories many of times. You get laid off. Maybe you're 60, you're going to work till 63 or 65 to get your insurance, but you're getting laid off at 60. So I see that a ton because it costs them more to have you on board, right? And then they're bringing in these young bucks and they can pay them less. So we see that a lot. I see health concerns. Health concerns is a big one. And it's not just you losing your health or just something really happening. Sometimes it's your spouse, right? So you quit work to take care of your spouse. So I've seen that a ton of times. And then the sandwich group community where you're taking care of your parents. And so I see that not as much, but I still see it enough to see that, it retires people a lot earlier. And so it's nice that you can do that. But if you were planning on working 10 years, I've seen people retire 10 years early taking care of parents, right? It's nice that you can do that. Maybe I'll notice there's potential inheritance if it works out that way. So there's a lot of reasons. So wouldn't it be nice, Randy, if somebody who, let's for example, 55 years old, they come into Zinnia and it's like, I've been listening to your show for a long time and I don't know. I am healthy. My parents are healthy. My kids are healthy. Everything's great. But we never know what God's perspective on great is going to be. And we never know when we turn the corner what's going to happen next. And that is a true statement every day. So I want a plan to know that if I get laid off, because I'm not going to retire till 62, Charisse, if I get laid off at 56, if I get laid off at 60, what happens to me in my asset? Can I stay retired? If my health goes, if my spouse's health goes, whatever it might be, can I retire now, Cherise? So that's a big question. I'm writing a book about, can you retire now? And when you come in, we're going to do the math, and we're going to show you based on what you save today, based on what your, maybe if you have a mortgage or bills, those liabilities, do you have a pension coming in? Do we have enough saved until pension Social Security kicks in if you were planning on collecting at 62? So we're gonna build that plan out for you so you know ahead of time. Can I tell you, I mean, think about it. You guys are listening right now. How good would that feel to know? But better yet, how good would that feel to know when your boss ticks you off, you can say, I'm out of here, Chuck. Right? And so you have total control, Randy. You said it best. You have total control now because you know the plan. And if you know, hey, I have to save another 40 grand or $100,000 before I can retire, it means you got to be nice to your boss. And then if something health-wise happens, you really got to figure out a plan. How do we manage that? So we got to work around the clock to figure out all these strategies. But wouldn't it be nice to know if something were to happen? Do you have options? Total control. I love it, Randy. Well said.
Yeah. I think that, all these years that you've been working, your employer has been in the driver's seat because they got the paycheck and they make the rules and all that. But when you sit down with Cherise and the math says you can retire anytime you want to, you go back to work with a whole new attitude. And now all of a sudden you're in the driver's seat. And it doesn't even mean that somebody ticks you off or anything like that, but you can literally call the shots. You can say, hey, if you want to let me go, fine, I'm good. But I can stay here and I can make a paycheck and I can be a valuable employee to you as long as you want, or as long as I want. And that is an interesting dynamic.
Feels good. Sounds good to me. Let's do it, everyone. Come in, get your plan.
833-368-3680. 833-368-3680 is the number. What does that do? That sets you up and gets you a date on a calendar and sitting down and saying, okay, here's all the papers. This is what I did for retirement, and this is what I want to do in retirement, and here's my bills, and this is what goes out every month, and I got to figure this out. This is what Cherise does every single day. 833-368-3680 or ZinniaWealth.com, ZINNIA Wealth.com. Hit the gold box there. It says complimentary retirement consultation. Cherise, I'll give you the last word on this one.
Alrighty. Thank you all for tuning in. I feel like we're really digging in about emotions and income and stock markets with all the noise out there. So I think it's time people really start to tune in and pay attention because there are a lot of people putting their heads in the sand. So live by design and not by default. And we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at ZinniaWealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Cherise Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and/or categories usually do not deduct transaction and/or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.